If you're retired or getting close, there's a decent chance that you've spent years obsessing over returns while barely even thinking about taxes, except in April. But that's a problem because in retirement, what matters is not just what your portfolio earns, it's what you get to keep. And yet, a surprising number of advisors out there still treat tax planning like it's a side dish instead of part of the main course. Or they avoid it altogether due to their compliance departments. Today in the Retirement Income Lab, we're going to talk about 5 tax strategies your advisor may not be talking about that could save you some real money over time. No gimmicks, no loopholes, and no offshore accounts, just practical moves that can help keep more of your money away from your silent partner, the IRS. I'm Patrick Huey, certified financial planning practitioner, and let's put your taxes under the microscope and get to work in the lab.
You're entering the Retirement Income Lab with certified financial planning practitioner Patrick Huey, where your questions about retiring and staying retired get answered. No hype, no stock tips, just data, discipline, and the right decisions to help you make retirement a reality. You ready? Good. Let's get to work in the lab. Here's your host, Patrick Huey.
Welcome back to the Retirement Income Lab, where high-saving professionals turn portfolios into paychecks that they can actually live on. Now, if you're within about 5 years of retirement or just getting into it, this series is for you because we stress test real retirement income decisions so you don't have to test them out there in the real world with your own life savings. Now, if you watch this and think, hey, that sounds like us, you can always schedule a retirement income lab assessment with me at victoryindependentplanning.com/contact. More on that in the show notes, but for now, let's talk taxes. Before we begin, one quick point. Tax savings, obviously, evidently, I think, should not be the only goal. As I've said elsewhere, tax savings alone are rarely a reason to do something. Or as some in this business have said over the years, don't let the tax tail wag the investment dog. And that's fine. But if you're already trying to build a smarter retirement income plan and you can save some money along the way, you might as well get all the good out of it that you can. So today, let's go through 5 places where good tax planning can add some real value. The first strategy is the big one. It's the one that a lot of people are talking about these days, some who should and some who quite frankly shouldn't. And that's Roth conversions. Roth conversions in the years between retirement and your required minimum distributions. Very often, this is the sweet spot for retirees. Why? Because many people retire in their early or mid-60s, but required minimum distributions, RMDs, do not start until later, right now age 73. And guess what? It creates a window where your income may temporarily drop, at least for tax purposes. So if you're living on cash, taxable accounts, or a combined withdrawal strategy, maybe Social Security hasn't even started yet, well, you just might be in a lower tax bracket than while you were working. And that is an opportunity because it can create room to convert part of a traditional IRA to a Roth IRA at a tax rate that is lower than what you might face later. Think of it this way. If the IRS is your silent partner in that IRA, kind of just sitting there waiting for you to take distributions so they can take their tax, a Roth conversion is one way of buying out part of their share while the price might still be reasonable. Simple example. Let's say a couple is retired and they have $70,000 of taxable income, and the top of their current bracket gives them room for another $40,000 before moving up a tax bracket. Instead of wasting that room in the bracket, they just might choose to convert $40,000 from the IRA to the Roth, pay the tax now, and reduce future required minimum distributions. And that can also help with your future tax brackets. It can help with Social Security taxation. It can help with Medicare premium surcharges. And it can also help with what your heirs eventually would inherit. So if your advisor is only talking about investment performance and not looking for these Roth conversion windows, that's a miss for your advisor and, more importantly, for you. Strategy number 2. Don't assume retirement withdrawals should come from one account until it's empty. This is one of the easiest ways to overpay in taxes over time. Because a lot of people think, well, I'll spend my taxable account first, then my IRA, then my Roth. Or a version of that is I'm just going to leave my Roth alone as long as possible. And sometimes that works, but sometimes it absolutely does not. The better answer is usually a little bit more nuanced, because a smart withdrawal strategy often blends taxable income, IRA distributions, and sometimes Roth money. Why? Well, because you're trying to control your tax bracket over time and not just this year. For example, if you withdraw only from your taxable accounts for several years, leave your IRA untouched, you may be setting yourself up for larger required minimum distributions later. What's the problem with that? Well, you may not need that much money coming from the IRA, so it's tax inefficient to take more. And that may end up meaning a bump up on the tax bracket ladder. On the other hand, if you pull too aggressively from the IRA too early, you may just create unnecessary taxes in the near term, in the now. So a better approach might just be to fill up lower tax brackets intentionally with IRA withdrawals or conversions while using taxable or Roth money to complete your paycheck. This is one of those areas where the order matters a lot more than most people think. Same spending, same eventual amount in your pocket, but potentially a very different tax bill. Strategy number 3. If you're charitably inclined and you're over the age of 70 and a half, please consider using qualified charitable distributions or QCDs. This one is, in my experience, hugely underused. A QCD allows you to send money directly from an IRA to a qualified charity. For my clients, we give them charitable checkbooks so that they can write checks directly to a charity from their IRAs. And that distribution can count towards their required minimum distribution. But it does not show up the same way as taxable income on your tax return. Basically, doesn't show up as taxable income at all. Why does that matter? Because lower adjusted gross income can affect a lot more than just income taxes. It might also help reduce that taxation on Social Security, your Medicare premium surcharges, and other income-related phase-outs. And I'm thinking particularly of the expanded deduction for seniors, which has, in my opinion, a fairly low phase-out for income. So this is especially useful now that many retirees take the standard deduction and don't receive as much benefit from itemized charitable deductions as they once did. Now, starting in 2026, you can even combine the two because once again, you can deduct up to $2,000 per couple in cash charitable contributions, but anything over that can come from QCDs. So if you already give to charity and you have IRA funds, a QCD can be one of the cleanest and tax smart moves available. As I've said before, charitable intent should drive giving. That may seem obvious, but if you're going to give anyway, you should at least use and know about the very best tools available. Strategy number 4. Pay attention to asset location, not just asset allocation. Many investors have heard about allocation. I'd say most at this point. Where you put your money between stocks and bonds and alternatives. And it's the pie chart that every financial advisor shows you during a quarterly review. But fewer think carefully about where specific investments should live inside of that total portfolio. And it matters because different accounts get taxed differently. For example, ordinary income producing assets may be better suited for tax advantaged accounts. In English, that means things like bonds may be better for IRA and 401ks. Why? Because they produce income through dividends or interest. And that is taxed at higher rates than capital gains. So an alternative is stock index funds, which tend to be pretty tax efficient. Those fit pretty well in taxable accounts. And finally, Roth accounts are especially valuable because future qualified growth is tax free. So this is not just portfolio housekeeping. Done thoughtfully, asset location can improve after-tax returns over time without changing your overall risk level. That's worth repeating. You may be able to improve your after-tax outcomes without taking more investment risk simply by being more intentional about which assets live in which buckets. Same portfolio, better after-tax results, better after-tax life. Strategy number 5, watch for hidden tax cliffs. A lot of retirees tend to think in terms of tax bracket only, but in retirement, especially now, there are other cliffs and traps that matter. For example, higher income can make more of your Social Security taxable. Higher income can trigger IRMA, IRMAA. That's the Medicare premium surcharge. And capital gains can interact with other income in ways that surprise people. And finally, RMDs, those can push you into brackets or surcharges that you didn't expect. So good tax planning is not just about, hey, what tax bracket am I in? It's also what happens if I recognize one more, 10 more, or 1,000 more dollars in income. Sometimes a move that looks fine in isolation creates a pretty nasty chain reaction. And sometimes a bit of income management can help you avoid that. A well-designed retirement plan should look around corners here, not just fill out a tax return after the fact. We want to be proactive. So let's say a couple has $1.8 million total in savings. Most of it is in pre-tax IRAs. Pretty common from what I see. They have some taxable savings. They've got a trust or an investment account, and they have a smaller Roth. Plus, they're charitably inclined. Well, a weak strategy would basically say, take what you need, we'll deal with the taxes later. Or just spend down the taxable account and then we'll take everything from the IRA. Not optimal. A better strategy says, let's use the early retirement years for partial Roth conversions. Let's draw from multiple account types intentionally. Let's use our QCDs, qualified charitable distributions, once we're eligible to do so. Let's place the least tax efficient assets in the best locations. And let's monitor our income so that Medicare, Social Security taxation, and the cliff for the expanded senior deduction don't sneak up on you. Now, does this eliminate taxes? Certainly not. But it may reduce your lifetime taxation meaningfully. And in retirement, reducing lifetime taxes is often more important than winning one single tax year. So what have we learned? Well, first of all, tax planning is not optional in retirement. It's part of the income planning process. Second, some of the best tax strategies are not exotic, but they are overlooked. Third, Roth conversions, withdrawal sequencing, QCDs, asset location, and income cliff management can all create real value over time. And fourth, if your advisor cannot clearly explain where tax value is being added for your portfolio, I think it's fair to ask exactly what you are paying for. Remember, the goal is not to let the tax tail wag the dog, but the goal should also be to not blindly hand more over to the IRS than necessary. Now, if you've watched this and you're thinking, we have investments, but we don't really have a tax strategy, it's exactly the kind of thing we work on in the Retirement Income Lab assessment. I'm a fiduciary. I'm a certified financial planning practitioner, and I'm the owner of Victory Independent Planning. And I work with high-saving professionals just like you, nationwide, who are within about 5 years of retirement or recently retired. And in this assessment, we can review your account types, identify any Roth conversion windows, evaluate some of your withdrawal sequencing, stress test your future tax exposure, and help build a retirement income plan that's designed to keep more of what you earn. So if you'd like a second opinion on what you're doing, go to victoryindependentplanning.com/contact and schedule a short call with me to get started. And if you found this helpful, please subscribe to the Retirement Income Lab and hit that like button. It's going to help more people find these conversations so that they can get the help they need for retirement. Next time in the Retirement Income Lab, we're going to talk about one of the most emotional and controversial decisions in personal finance, and that is when to claim Social Security. Because for a lot of couples, this is not just a filing decision. It's a longevity decision, a tax decision, and a spouse protection decision. You won't want to miss that one. I'm Patrick Huey, and I'll see you next time in the lab.
This has been the Retirement Income Lab with certified financial planning practitioner, Patrick Huey. To stress test your own retirement income plan, visit victoryindependentplanning.com/contact and schedule your introductory call today.